Our classroom stock portfolio of high-yield dividend-paying companies now has an annual return of 31.92%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 21.89%, and this week made some progress in catching up to our high-yield portfolio. And like in last week's video, later in this video I will discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. Now on Friday, the large banks like JP Morgan kicked off the earnings season with fantastic earnings reports. Over the next month, we should see a shakeup in our weekly list of the top stocks as companies report their third quarter earnings. The bull market is now 2 years old as of yesterday. The S&P 500 has risen 67% since then, and according to the Center for Financial Research and Analysis, all 14 bull markets since 1947 recorded an average bear market recovery of 375%. Since we are only up 67% for this bull market, and the average bull market saw stocks rise 375%, this implies, but does not guarantee, that this bull market has much further to run. So what is this slide showing? It's showing the portfolio value over time for our main stock portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,537.14 after 145 weeks, a new high for the portfolio. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we'd instead invested or put the money into a savings account. In our first year, 2022, stocks did not do well, and neither did bonds. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. The power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April this year, but has been the best performing portfolio over that time, although with a lot of volatility. And for those that have been asking, I put the Dividend-Growth stock portfolio and the high yield stock portfolio on our site, which is beatthestockmarket.com. More on that on the next slide. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, a little over 2 years ago, each Monday, I invest actual real-world money, $12.50 each week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,537. The portfolio's return has been 21.89% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And the preceding year, the portfolio once again beat the market. For those that have requested it, I've now put the dividend growth stock portfolio and the high yield portfolio on my website. And because the high yield stock portfolio currently lacks any technology stocks, I've added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. And for those that can afford a subscription, I'll continue doing these weekly videos on the weekend showing what I bought on the previous Monday. Subscribers will have real-time access to the list of stocks we buy each Monday, as well as real-time notifications when we sell a stock. Subscribers will also get a detailed report of portfolio holdings, and they will get access to the complete history of our trade confirmations, which we're in the progress of posting online. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. The high yield portfolio was started in August 2023, and the annualized return so far is 31.92%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 25.8% over the same time period. I would expect that the dividend growth portfolio would have the higher return, and this week it's caught up a little bit, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. As I mentioned earlier, on our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Oops, I went too far in my slideshow. Now remember, the high yield portfolio has only existed for 14 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return, which has existed for a longer period of time. Now this slide shows the cumulative growth of the dividends we have received in our dividend growth stock portfolio. This is a fantastic visual of the power of compounding growth, and this is still very early in the portfolio's lifespan, if you will. Our dividends for the latest quarter increased 39% over the previous quarter, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly dividends are growing, and like I said, is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main stock portfolios? The first reason we stick with dividend-paying stocks for our 2 dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. The second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, in other words, the more up and down it is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested into companies that grow their dividend, in other words, dividend growers, and companies that started paying a dividend, those are called dividend initiators, grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay a dividend by 116.7%. Now, the holy grail of dividend investing is to have a stock portfolio that produces 2 things. 1, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are 2 examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invest in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 8.21%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I expect Broadcom to increase their dividend in the fourth quarter. And I fully expect Broadcom to continue to increase its dividend well into the future, not just the next quarter. And if not, that's why we have constructed a very diversified portfolio. That's the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend-stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in that portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents per year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a dividend yield because the stock's price has risen so much. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 tax-free of income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $61,625 and will likely increase pretty soon as the new IRS information comes out. These amounts often increase each year, as I just mentioned, and the standard deduction increases, or as the standard deduction increases, and tax brackets are adjusted. So how are these amounts calculated? First, you would find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which is located in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students, who are often, considered starving students, they don't have a lot of free cash, that you don't need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account Fidelity allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, when I started the dividend growth model portfolio, I invested $25 per paycheck, but found the process to be so fun that we split it up and now invest $12.50 every week. And we boosted contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, As I mentioned, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. For a classroom dividend-growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And it's looking that inflation this year will be even lower. Now, a very popular exchange-traded fund, ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend-growth stock portfolio's annual return is 21.89%. If we had instead invested the same exact amounts into the ETF with the ticker symbol SCHD on the same days, the portfolio's return would only be 13.02% per year, a difference of 8.87% per year. Our high yield portfolio is also outperforming SCHD. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps, and that's a bad thing. This slide shows our best performing stocks in our dividend-growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, and Broadcom, a chip maker, switched places this week and still remain at the top. Both have total returns over 200%, which means investment has tripled since its initial investment. So far, 2 stocks have tripled, and 6 stocks have doubled their initial investment, with ITT and Carlyle joining the group this week. Ameriprise makes the list with a 67.5% total return on its initial investment in less than a year and a half. Stocks in yellow have been sold. Those are F&G annuities and ReposiTrak. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend-growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. Now, the other 10% or so of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, like F&G annuities in yellow and ReposiTrak in yellow, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing dividend stocks this week for the dividend-growth portfolio. It does not include dividends. The best performers were Air Products with a 10.9% increase this week, Clear Secure 9.7%, NVIDIA at 7.9%, and WK Kellogg at 5.6%. This slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer holdings than our dividend growth portfolio. The best performers were Cogent Communications at 5.7%, Kinder Morgan 4.6%, Goldman Sachs 4.3%, and M&T Bank. And this slide shows our best performing stocks this week for our tech stock portfolio. Now, the tech stock portfolio can invest in stocks that pay dividends or do not pay dividends. The best performers this week were Zscaler at 14% increase, Cloudflare 12%, CrowdStrike at 9.6%. So some cybersecurity stocks did pretty well this week. Before we look at the 10 stocks we bought this week for our dividend growth portfolio, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow have been sold. On the left side of the screen are the 10 dividend growth stocks we bought a year ago. Stocks in yellow, like I said, have been sold. American Express has been the best performer with an 86.8% total return in a year, with FMC and Dollar General being the only clunkers. The average return of the 10 dividend growth stocks we bought a year ago is 39.7%, with Fidelity National only being held for less than half a year. Therefore, the annualized total return of 42.18% is higher. On the right side of the slide are the 8 purchases we made for our high yield stock portfolio. It utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock, like we did with Bank of New York Mellon and Devon Energy. The average return of the high yield stock purchases we bought a year ago is 32.92%, despite 5 of the purchases not being held the full year. The annualized return for all 8 of our high yield purchases is 43.25%. Obviously, our purchases will not continue that high rate of return, but it's a great start for this portfolio, which is about 13 months old. And here is a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So here are the stocks we sold this week. We don't make sales very often, but we did sell NiSource for both our dividend growth and our high yield stock portfolio. The total returns based on the initial investment for each portfolio were 35.2% in 5 months for our dividend growth stock portfolio and 31.7% for our high yield stock portfolio, also for 5 months. But the initial purchase of NiSource was not the best price we got. Based on all purchases for the high yield portfolio, the 21 times we bought NiSource provided an average total return of 36.8% with an average holding period of 282.7 days. So that's an annualized return of 49.9%. Pretty crazy for a stock that is a utility stock. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks as of last Monday, but we only buy 10 per week. We purchased the first 10 stocks on the list, and none of them are in yellow. If there was yellow, that means we didn't buy them because they are 4% or greater of our portfolio. A brand new position we started this week was Yum Brands, which operates many restaurants. The company has a 2% yield when we bought it last Monday and has earned a quality rating of A+. Only 5 other stocks on this list have that high of a quality rating. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. Also, if we sold a stock, we throw those proceeds into that amount. We then take that combined total and split it up amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we were purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, also called a DRIP feature. But we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be ASML, Qualcomm, and Constellation Brands. Oops, correction. The most undervalued stocks last week appeared to be Lamb Weston, Qualcomm, Albemarle, and Constellation Brands. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Stocks with the highest yields were, in order, Pfizer, PNC Financial, Pepsi, and M&T Bank. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks in the next few slides. This week I purchased over $2,800 of these stocks as I reinvest dividends and gradually transfer out of my dividend ETF and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns, and I'll share the results when I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. In other words, we did not buy any under the radar. Those under the radar stocks are a little bit more rare for purchasing. Risk is the first quality component on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, Nike, Yum Brands, and Pepsi. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Microsoft and Air Products. And remember, Air Products saw its price rise 10.9% this week. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lamb Weston, PNC Financial, and Pepsi. All of these earned an A- or better grade. Ideally, you want a high dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it usually works. Companies that are already paying out higher dividend yields rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are McKesson, Microsoft, and Albemarle. These earned a B or better grade. The companies with the best combination of recent dividend increases and potential for future dividend increases are McKesson and Microsoft. Here are our trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus the proceeds from the sale of NiSource and plus any dividends that had recently been received, and then invested them in the top 10 stocks on our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's return. 1, each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost the return of the portfolio is to buy only the stocks rated in, say, something like positions 1 through 5. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. I'm not, but not everyone has the same conservative attitude that I have. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Now, normally, if a stock's allocation in the portfolio is 4% or greater, and a company that's close to that right now is Microsoft, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in one or two stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all your expenses plus generate extra income for vacation, travels, etc. Now, I'm a conservative investor and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's return, especially if the company is in the top 5 of that week's ranking, as mentioned in the first bullet point. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities' 119% gain in 12 months, and Repositrax's 97% gain also in 12 months. On average, so far, they've not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well as large stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And finally, number 4, you could sell when a stock is fairly valued, even if the dividend and quality metrics are excellent. Now, we don't sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts the dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and your methodology signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stock. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says you have to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested just $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at the stocks that have raised their dividends recently for our dividend growth portfolio. The holy grail of investing in dividend-paying stocks is to have your portfolio generate enough dividends to cover your annual expense, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. We should start seeing even more dividend increases as many companies start announcing their third quarter results over the next month and a half. The last 2 dividend increases for the dividend growth portfolio have an average increase of 10.2%, well above the historical average. So far, so good. This slide shows stocks in our portfolios that have chosen to split their stock. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we've received once a stock split has occurred. And the most recent stock split was Lam Research's 10-for-1 stock split on October 2nd. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Currently, 4 stocks comprise 4% or more of the portfolio, with Allegiance still leading the way. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if it makes up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. I saw a lot of people panic in 2020. A lot of people panicked in 2018. A lot of people panicked in 2008, 2009, and never got back in the market, and they've missed out on some huge gains. Our portfolio holdings currently are at 99. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company. Once we download company financial and accounting information to the spreadsheet, which we do at least weekly, and doesn't take that much time. But the thing that did take a lot of time was creating the spreadsheet. It was 2 years of hard work. Now let's talk about our high yield dividend paying stock portfolio. I have had several older students who are closer to retirement take my classes. They are more interested in stocks with a higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return so far of 31.92%. Since the portfolio has been in existence for about 14 months, our return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for over 2 years. Currently, the high yield portfolio's dividend yield is 4.19% if you bought everything today. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement or in retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 4.97%. Now, 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, both high yield and dividend growth. So which one has performed better so far? It's been Strategy 2. The average investment in Strategy 2 has provided a total return of 18.33% and has been held for an average of 178.4 days so far, which is an annualized return of 41.13% using Excel's rate function. Now, it's not likely the portfolio can keep up an annualized return that high since stocks historically average about 9 or 10% a year. On this slide, we're looking at the high-yield dividend-paying stocks we bought last Monday. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite on the website. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. So don't buy something with a 10% yield expecting it to raise its dividend significantly. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks. And we have 2 different strategies within this portfolio. So basically, we're buying the top 4 stocks in each of the 2 strategies. Strategy 1, as mentioned earlier, emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 in red, and 4 stocks in strategy 2 in green, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing strategy 1 are Bristol Myers, HF Sinclair, Pfizer, and CVS Health. The 4 high yield stocks we bought this week while implementing strategy 2 are PNC Financial, M&T Bank, Pepsi, and Pfizer. This week's purchases have an average yield of 4.3%, with Pfizer coming in the highest with 5.9%. And here's a look at Monday's ratings, last Monday's ratings for Competitive Advantage, Management, and Financial Health. And on this slide, we can see Monday's grades for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be usually much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus the proceeds from the sale of NiSource plus any dividends that had recently been received, and then invested them in the top 8 stocks on our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. Oops, I need to remove that last sentence where I said we don't invest in them if they have 4% or greater allocation. This high yield stock portfolio does have less diversification than the dividend growth portfolio. So if a stock in this portfolio has an allocation of 4% or greater, we still will invest in them. So this portfolio has higher concentration, has many fewer stocks in it than our dividend growth portfolio. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks, as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we aren't investing in any additional funds each week into this portfolio. We're sticking with the original $1,000 investment to see how far it can grow. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta platforms and Google are in the portfolio, but are both in the communications sector. So far, the portfolio has increased 30.4% in a little over 9 months. In comparison, technology ETF with a ticker symbol XLK is up 20.5% over the same period. The best performers in the portfolio so far are NVIDIA at 180% increase, Meta Platforms 72%, Broadcom 68.5%, SAP 53.7%, Pure Storage 53%, IBM 48%, and Fortinet at almost 44%. Back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Now, I hesitate to call this a portfolio since it's limited to only one sector, the tech sector, but it's been fun to follow. Since this portfolio started, it has outperformed the 2 dividend portfolios over the same time period, but that's a short time since it was started on April 29th of this year, and its volatility has been very high. Not for the faint of heart. So how is this portfolio different from the $1,000 tech portfolio shown on this previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Meta and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. Now, it doesn't matter if they pay a dividend or not. this is not just a dividend portfolio. The average investment so far has been held for 83.5 days and has produced an average total return of 9.69%. Using Excel's rate function, that's a 49.86% annualized return. If we'd instead invested our weekly investment into the technology ETF with the ticker symbol XLK, instead of a 9.69% average, we'd have an average return of 6% with the same holding period. Note that these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discuss in Classic and we use on all large stocks, whether they pay a dividend or not. The top 4 tech stocks on our list last week were Adobe, Microsoft, NICE, and good old Lam Research. So in the comments, let me know if you have any questions. Also, let me know if there's any other type of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. And finally, remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, which is less frequently, as well as information about portfolio holdings. So I'll see you again next weekend with a list of stocks we will have purchased on Monday. See ya!